When people hear the words interest rate hike, most don't realize how powerful those two words are. Interest rates control the flow of money in the entire economy, and because the stock market runs on liquidity, confidence, and future growth, interest rates can completely change the direction of capital markets. In simple terms, when central banks like the RBI or the Federal Reserve increase interest rates, borrowing money becomes more expensive. Businesses pay more for loans, consumers spend less, and investors become more cautious. But when interest rates are reduced, money becomes cheaper, spending increases, and businesses expand faster. Markets usually become more bullish. Understanding this relationship is one of the biggest advantages an investor can have. Imagine the economy like a giant machine powered by money. Interest rates decide how fast that machine moves. When rates are low, companies borrow easily and invest aggressively, creating a path for massive market growth. More jobs are created, consumer spending rises, and corporate profits improve. This creates optimism as investors price in future growth. During periods of low interest rates, sectors like tech and real estate perform strongly. Cheap money pushes investors toward riskier assets as savings returns become less attractive. But when inflation rises, central banks increase interest rates to slow the economy. Higher rates reduce spending and cool inflation but impact the stock market negatively. Companies face higher borrowing costs, and future earnings expectations fall. This is why markets often react sharply during aggressive rate hike cycles. Growth stocks and tech companies are hit hardest as their valuations depend on future earnings. Higher interest rates ultimately reduce the present value of those future profits. Interest rates affect where big money flows. When yields increase, investors move from stocks to safer government bonds. This shift reduces market liquidity, often leading to higher volatility. Conversely, falling rates fuel massive bull markets as liquidity returns to equities. But markets also react to expectations. Prices often crash before a rate hike or rally before a cut as traders anticipate future policy. This is why smart investors watch inflation data and central bank speeches. In the end, interest rates are like gravity for the financial world. When rates are low, markets can fly higher. When they rise aggressively, gravity pulls harder and markets struggle to move upward. Understanding this money flow is what truly drives capital markets over the long term.